The coinage of valuation is spurious. Well, that's comparatively relevant today concerning banks in the financial crisis. But now INSEAD Professor Jean Dermine has created a better way based on his 25 years plus of research into the banking industry. And he's written Bank Valuation and Value-Based Management. And it's just been published in New York by McGraw-Hill. Thanks for being with us. Appreciate it. What is driving bank valuation?
I was in finance, like for every company, we look at future cash flows produced by a bank. But what I do in the bank is, what I do in the book is to show that we can break the value of a bank into very basic and very intuitive components. The first one is if you liquidate the bank today, how much value can we get out of a bank? If you let the bank go on, there will be additional value created by collecting low-cost deposits, granting higher return loans, selling cash management services, M&A services, asset management services. So what we do in the book is to break the value into pockets of values related to different activities.
Now, have books like this been written before? I mean, what made you write this now?
I wrote the book for two reasons. First, it is a bit surprising, but very, very few books or articles has been written on bank valuation. I mean, you have hundreds of books on corporate valuation, but almost nothing on banking. And two, there's a lot of talk about value-based management. How do we create value for a company? But in banking, if you do not have a sound bank valuation model, you cannot really discuss value-based management.
Can you give some concrete examples of how value-based approach leads to better management?
I'll give you two very, very simple examples. There was a study recently by Goldman Sachs that all the banks will suffer because of the new capital regulation. Capital will be much higher, leverage will go down, banks will have a lower return on equity. That is totally correct. But when we talk about the value of a company, it's not only about return on equity, it's also about risk. So we can show that yes, banks may suffer with lower return on equity, but if they have more capital, they will be less risky. Therefore, when you put the two together, you can discuss what will be the impact on value.
So it balances in a way.
It will balance in part. The second very, very simple example, when a bank goes into a 5-year loan with high interest, high margin, you say that's wonderful for next year, next 2 years, there will be a wonderful profit. But when you talk about value, you have to look at the long-term cash flows. What is the risk that's going to materialize later on? And therefore, you see that the short-term margin is quite often illusory because of future risk. Therefore, a focus on value is forcing you to look way, way beyond the short-term cash flows to look what happened later. And I'm personally convinced that one of the reasons for the crisis is that banks are way, way too much short-term driven. They see this wonderful margin on subprime in the short term, and they go into billions of dollars in this market, ignoring longer-term concern. And so I believe that a value-based approach is providing a better way to manage a bank.
So do you think do you see any evidence that this might be changing, this short-term focus is beginning to shift?
Yes, something extremely important has happened 2 or 3 weeks ago. The International Accounting Standard Board has been coming with a proposal to force banks to create provisions on performing loans. That is to say, even if a loan is doing well today, we want to recognize a risk that may show up later on. Therefore, we are going to force you to create provision very early. So this is really was discussed in the book, now being recognized finally by the accounting profession.
But that could put even more screws on the credit crunch if banks are, that means less money in circulation if they are going to be provisioning against performing loans.
I think a simple approach that risk has to be priced properly. I mean, we have gone in history over too many banking crises because risk was not priced properly. So yes, risk will be priced properly. Yes, the cost of fund will be higher. But I would say that's sound economics.
So what are the key issues relating to risk that apply to valuation that in your sort of theory?
Two simplest examples is as I have given the example of credit risk. How do you look at a long-term loan, whether the short-term margin is really a profit or whether it's really there to cover risk? Another simple example, we hear all the time the banks saying that when the interest curve is going up, it's a good time for banks because they borrow short term at a low interest rate, they lend long term at high interest rate, they have a nice margin. This is a perfect example of a fallacy because yes, it gives you a profit in the short term, but in longer term it's going to show a loss. And therefore a value-based approach which is forcing you to look not only at short term, but long-term implication, give you a much better balanced view.
Is that kind of what's happening in Spain at the moment? They were praised for making or forcing banks to create dynamic provisions in good times.
Indeed, Spain has been very much praised in the last 2 years because when the economy in Spain was booming, the Central Bank of Spain has forced the Spanish banks to create general provisions. And the idea was to say, well, if ever we go into a recession, which is the case today in Spain, they can take money away from this provision. What we see in the book is that it's not only important to create this general provision, but a second, which in my opinion is much more important, it is the issue of incentive. How do you evaluate a loan department? How do you make sure that you reward them for taking good decisions? And as I was explaining, too often banks look only at short-term interest margin. They say it's a great profit, we pay you big bonus, and then banks take too much risk. So the issue is not so much creating general provisions as the Bank of Spain is doing. It's forcing banks to measure way better performance. And that is forcing banks to recognize risk and provision much earlier.
Let me ask you a question about something that is an off-balance sheet transaction. Some of the insurance type of claims, credit default swaps. That's kind of the poster child of problems these days. Can they ever be on balance sheet? Should they be? They're really not banking provisions, but they create problems for the bank if they go wrong.
Because credit default swap is very much it's like an option, like an insurance product. It's simply a promise by a party to cover credit risk if something happens. So because it's a promise, it will never be on balance sheet, therefore an off-balance sheet commitment. But there are two major accounting issues that should be improved related to this credit default swap. Is first for banks or insurance companies to disclose in their annual report how much of this credit risk insurance they are selling.
And they haven't had to do that up till now.
And there was a tremendous amount of opacity. The best example is that when AIG was in difficulties, one of the major reasons why the Federal Reserve came to basically help the bailout of AIG is that they simply didn't know. If AIG was defaulting, they simply didn't know what would be the implication on other banks. They simply did not have the data available on the risk exposure. And then the second accounting issue is that when the economy deteriorates, logically a bank, an insurance company, should recognize very clearly a provision to recognize that the credit risk is increasing. And too often, banks have been delaying the provisioning, hoping always that things would get better. And that's when suddenly we end up with a huge loss, which comes as a surprise to the market.
What's the message we should be taking away from the book?
A value-based management approach will clearly help to avoid many of the mistakes we have seen. Whether it is credit risk, whether it is mismatching of balance sheet, too often it's giving a false impression of short-term profit when in fact risks are going to be hidden later on. And this is no magic finance. In fact, it is fairly basic finance. But applied to a bank, it leads to very useful practical propositions.
You've been with INSEAD since 1982, so that's quite a long time.
You may say so, yes.
Well, yes. And you've been leading research, management development programs for the banking industry.
Just 2 weeks ago, we celebrated the 20-year anniversary of an INSEAD executive program called the Inter-Alpha Banking Program. It's a 4-week program for a consortium of European banks, including big banks from each European country, Santander in Spain, Royal Bank of Scotland, ING, Intesa San Paolo. And so looking back to see that this program has been lasting 20 years, it is pretty impressive.
Thank you very much, Professor Dermine, for being with us
Thank
on
you,
INSEAD Knowledge.